Hi, kids. I'm going to try to go through problem 1B3. 1B3, you have the solution in a Word doc. I flipped this around and set up a PDF for it. So you'd want to grab the textbook and follow along. And we're talking on page 35, problem 1B3, which is a model for 1A3, which of course is one of your assignments. So you grab your book, you go down to 1B3, that's problem 1B3, and it starts off with a new investment of $30,000. So our business starts out, as you can see, with a $30,000 increase in cash, and Perlito capital has to be increased. Remember the rules, both sides of the equation have to balance after recording the transaction. So you got 30 and 30, left and right. The rules for recording transactions, at least two accounts. These are the accounts across the table here. This is an expanded accounting equation. I gave you 1A1 last night in its entirety. So you have to go to my accounting lab and pop your numbers in for problem 1A3, just as we're doing here in 1B3. So we're going to add, or you'll see we're going to be debiting cash and crediting the capital account. Two accounts are affected, and after recording the transaction, we bring the balance down and we can see that the equation is in balance. The next transaction, I have it in front of me, bought new office equipment on account. That's a credit purchase, so we have to add to office equipment. Next chapter, we'll be debiting to add to an asset, and then of course the liability goes up, so we have to balance on the other side by showing the increase in accounts payable. Two accounts, they are office equipment and accounts payable. They're both going up, so we're going to be adding the 5 to the equipment and adding the 5 to the accounts payable. That establishes the new balances for the office equipment and the accounts payable. We still have the 30 in cash, and the owner still has 30 in owner's equity. In transaction C, received cash from typing services rendered for $400. That's an addition to cash. And we go over to the owner's equity side because a revenue is an addition to the owner's equity, but it's kept separate in its own account called typing revenue. So we're going to be adding or crediting the revenue account. Again, that will end up adding in the end to owner's equity. Okay, so you bring your balances down. You can see you had to add the 400 to the 30 to get 30,400. Accounts receivable. Nobody owes us anything yet. You still have that office equipment. You still owe the $5,000. The equity of the owner is still 30, but it is going to be increased by 400 as a result of the typing revenue. Uh, transaction D. Transaction D, it says here, performed typing services on account. That means that we rendered our service, I guess we're a typing service company, so that we don't have the cash, so we can't add to the cash account. So, but we're going to get it later, hopefully. But in this problem, it doesn't show that we do get it, but it's still an asset because it's a claim that we have on other people's assets. That's what accounts receivable are all about. Monies are to be received in the future, typically for the rendering of services or the sale of goods on credit, a sale of services on account as we have here. We debit accounts receivable, which is an addition, and put the credit to the typing revenue. As you can see, the revenue account is increased up to 3,500, and all the other balances are established, continue as they were, but we have got now a new balance for accounts receivable. We still got all the equipment. We still owe the $5,000. Ferlito's equity is 30, but we know that if we had to calculate it at this point, we'd have to add the revenue of 3,500 because a revenue is an addition to the capital account. Now, in transaction E, it indicates in the book you paid the secretary's salary. That's a drain on the assets. As you can see, we reduce cash by 425, and we are going to be adding to the expense account for 425, so that actually they that's a negative. As you look over here, that's a negative overall negative impact on owner's equity. I'll show you down below what happens. But right now you have an expense which is on the negative side of owner's equity. So you'd be next chapter be debiting the expense account and crediting to reduce the cash account for 425. And you can see the reduction to cash. You still owed the 31, so you drop that, you drop that, you drop this, you drop that. You still got the accumulation of the revenue for 3,500, and now you've got the expense incurred on the books for 425. Transaction F, paid office supplies expense for the month. Apparently you bought them, you used them, so you looks like you're expensing them for $130 right away. Sometimes you buy them and hold them. You got to treat the supplies as an asset. Oftentimes, and you use them later, then you have to expense them. But apparently, we went to the supply store, bought the supplies, used them right up, so we expense them right here. Now, what you can see is that $130 adds to the expenses, which are now $555. See, in the end, we've got a total amount of expense of $1,305. So every time you incur an expense, you're adding to the amount of expenses, and then at the end of the period, when you calculate equity, you'd have to subtract those expenses from the capital account after adding the revenue and then subtracting the expenses. And the reality is we prepare an income statement. What we'd be doing is we'd be subtracting the expenses from the revenues, get the net income, and then add that to the owner's equity account. So what you see now then is you have a reduction in your cash account, which brings it down to $29,845. You are still owed that $3,100. You still have the office equipment. You still owe the $5,000. Ferlito's account would still show at 30, but you know that in reality it would be a total of 30 plus the revenue minus the expenses. In transaction G, it notes that we paid, it notes that we incurred the rent expense, but we still owe the landlord, so that if we incurred the expense during the month but haven't paid for it yet, that's an obligation that we have recorded as accounts payable. So we come over and charge the expense account, and we're not paying it right now, but we are putting a credit into the payables, which means we owe $750. You have to record the expense in the period that it was incurred. So what you're doing basically is you're taking away from owner's equity, and you're showing that you owe that amount to the landlord. So next chapter, we're going to be debiting the expense to add to the expenses. As you can see, that 750 adds up now to a total to the 555 to a total of 1305. So you'd phrase this as the incurrence of an expense on account or on credit. You always add to the expense and always add to the liability if you haven't paid it. When you do pay it, it doesn't show it here, but when you do pay that liability, what you do would be reducing your liabilities, and you'd be reducing cash. So finally, in transaction H, it reads withdrew cash for personal use, and that's an obvious reduction in owner's equity. It's not a business expense because it's not incurred on behalf of earning revenue. All right, it's for personal expenditures. He's got to buy his groceries and pay his own personal bills and so on, so that we keep it separate. It's a negative to owner's equity insofar that it drains assets out of the business. So if the assets are going down, something on this side has to go down. As you can see, there's a minus right over here. In the end, we calculate our balances. We take out that 500 from the previous cash balance down to a cash balance of, as you can see, 29,345. We haven't got paid yet. If we did get paid, we'd add to cash and we'd reduce the accounts receivable. You will get some of that going forward. We still have all the office equipment. So the left side of the equation here, you see a proof figure. You look on the right margin of the page there. They didn't enter it, but the total of the assets is 37,445. So you can see if you added 29,345 plus 3,100 plus 5,000 equals, they didn't write it in for me, and this is PDF, so I can't type it in, guys, but you can write it in at 37,445. Okay, and that's the left side, and it has to equal the right side, so that if you took the 5750, added the 30 in the capital account, subtract the withdrawals, so it's 30 minus 500 plus the revenue, 3,500, minus the 1305. You do that in your calculator. You can pause this video and you'll see that 30 minus 5 plus 35 minus 1305 will equal the same 37,445. So you'd have a balancing equation. Okay. Now, the problem could go further. I could ask you to do the financial statements, but the time will prohibit that. But we would do an income statement first, which would be the revenue minus the expense to show the profit. There is a profit there because the revenue is greater than the expense. And then we'd do an equity statement showing the 30 minus plus the profit minus the withdrawals. You'll see that on the problem number 4. You'll see that you have to do the 3 financial statements. Okay, I hope this helps. I'm trying to hold your hand as best I can here. So you got to go through this stuff, and you just can't ignore it. I want to stop my lecturing again. All right, see you later.